Welcome everyone to the June 2022 client update for self-managed super funds. Tonight I'll give you some information about what's been happening out there in this particular space and how people perceive self-managed super funds in general. Obviously it's general advice provided by me, not specific. If you have any issues in relation to your own affairs, you should seek your own independent taxation advice. Everyone knows me, so I don't really need to tell people much about myself. I think I've known most clients on the screen for quite a few years. So, and thank you all for joining me. Every so often, the tax office quite often will ask people to review if a self-managed super fund is right for them. They still have a lot of people who enter into the space that probably shouldn't enter into the space. And they think that you should, for a self-managed super fund, you should have at least 400,000 to 500,000 in fund assets to make it worthwhile. You also must act in the interests of your retirement and the other members. There's a whole lot of conform rules which you need to conform to, and they're set out by the ATO and the SIS regulations. Fortunately, most of our clients all seem to be relatively conforming to most of the rules. We do have the occasional one that slips through, and we work through with the client and the auditor to try and keep them out of jail. It's important that you keep records, minutes, keep your lodgements and document your decisions. We help most clients with that. I do suggest if you're making big investment decisions that you try and make sure that you actually document them yourself. So at the end of the year, we can ask questions and help you record that appropriately. We also suggest if you feel a little bit unsure about your investment strategy, that you seek independent investment advice from a reputable planner. And obviously with a self-managed super fund, there's the annual tax and audit fees. And always, final thing that the tax office always like people to do is act at arm's length. And that means that you've always got to be thinking about when you do a transaction that it actually relates to your super fund and your retirement strategy. Fortunately, most of our clients have done that. We've had a couple who have accidentally taken money from the fund, but in most cases, they've been able to pay it back. So this really comes to the crux of what the self-managed super fund is all about, and it's the sole purpose test. So in the professionals like myself will be told that we must make sure that our clients understand that the sole purpose test is to provide members with retirement benefits for members, beneficiaries or dependents with benefits in the event that a member dies before retirement. So basically anything that you do must be focused towards the sole purpose of your retirement. And I think if you keep that in mind, you don't get yourself into trouble. So as promised, I've been able to dig out some facts from the tax office. So basically when you lodge your return with the ATO and we fill out many labels, they use that information to monitor the sector. So a couple of facts that are worth noting. There's about 1.1 million members. The sector is actually still growing. There's 600 SMSFs, SMSF in Australia. And although this represents 5% of the population, they account for 822 billion or 25% of the funds invested in the superannuation system. Predominantly, it's the older person or older people that will enter into a self-managed super fund. Younger people don't, but those of late that have been entering in via crypto. We can see the types of fund and the growth and the total assets within the various funds, and you can see the self-managed super fund continues to grow. Obviously, the industry one is going to continue to grow as we now go into 10% up to 15% super guarantee charge. Interestingly, the Labor Party, now that they're in, will continue to play around with superannuation. There has been various media reports about what will happen in that space, and we'll wait and see in October when they release their first interim budget. I expect that there'll be probably more surcharges on the upper end of superannuation balances, and the concessions for the lower end of members will continue. These are the average returns for 2015-16 and 2019-20. We can see that 20 did start to slow down. That was COVID. And in 17, 18 and 19, I would say most of our funds that we do had relatively good returns. Some of them had lumpy returns. Most of our funds made money, and I would say some of them actually did a lot better than the industry funds. I saw returns last year ranging from probably 8% up to 30%. And the 30% ones might have been an adjustment to the valuation of their property. But overall, most of our funds have returned quite well. And despite the fact that the tax office says it costs a lot of money to run a self-managed super fund, the costs are quite comparable to the industry funds. They are going to redo their costing mechanism because they did state that they may have incorrectly included a value for trustees' time at $10,000, which wasn't really appropriate for many funds. This is the allocation per the ATO in 2020. We haven't got the 21 yet. Couple of points to note. We can see 26% are listed shares. We have 20% in cash. There's a residential properties only about 5%, and limited recourse borrowing arrangements is 6.8. So throw them together, it's about 11% in property, and non-residential property is about 9.5. Then we've got the unlisted trusts. Self-managed super funds in retirement phase had a very similar asset allocation to self-managed super funds in accumulation. The only noticeable differences were that self-managed super funds in retirement tended to favour listed shares. And I think that's because of liquid, while accumulation phase funds held a greater proportion in other investments like limited recourse borrowings and maybe non-residential retail property or unlisted trusts. So obviously, and that's probably in general what we're seeing with our older generation funds, that there is more listed shares and cash, and the younger funds are investing in property and crypto and everything else. So funds in retirement held 64% of total self-managed super fund assets. So we're basically seeing the grey tsunami come through, and a lot of people are in pension mode or going into pension mode in the next couple of years. This is an important one for everybody to note, and this was stressed by the ATO at a seminar I went to last week. And basically they're saying that the COVID days are now numbered. Even though COVID's floating around, the ATO have obviously got a job to do, and some of the relief that was offered is now being wound back. The rental relief, obviously for those with rental properties, that comes to an end in June. The 50% reduction in the minimum withdrawal requirements will continue for another year, and that was only announced in the May budget, and that's been ratified by both parties. So that's a good thing. So, and that means you can leave more into super if you don't need it for that year. The borrowing relief of 5% rule, in-house asset rule, not really applicable to many clients, but because of some of the values on properties might have dropped off a bit or whatever, or the shares, some of our funds that had borrowed money might have exceeded that 5% against the market value of the asset. So they were able to get away with that for that year. And the other big one that's now coming to an end is the trustee residency rules and being overseas. So if you were caught overseas, technically your fund may have been non-complying as an Australian resident fund because you weren't there to manage it, and they allowed that to take place for the COVID time. One of the things that was very prominent in the information I was given was to make sure that you fully document any rental relief matters that you've organised. And that's whether it's in-house or with a third party. Obviously, the auditor will ask for that sort of information, but it's also good for your own records that you've kept information about that. We had probably, out of the funds that we would do, I'd say 10 of our funds took advantage of either third-party rental relief relationships or internal ones with their own business. So there wasn't quite a few people that did do that. If you're fortunate enough to not be in that position, it's obviously better for your retirement. So I think this is a really good little slide just to remind ourselves what has happened in the last probably 5 years. And really in the superannuation space, we could say it's been a positive experience in the most cases. There's always the tax office or the government's tinkering with the tax rate, and especially those on the high end or above the cap or excessive contributions. But overall, there's been lots of opportunity, and there still is some opportunities. You know, we're all aware of the superannuation guarantee and the salary sacrifice arrangements that can happen to save super into your to reduce your tax. We also know that the personal deduction limit has increased in the last 2 years. It's not as good as what it used to be 10 or 15 years ago, but it has been upped a bit. And also that you can actually now put a personal deduction in rather than via your business, or especially for those that were self-employed or non-self-employed people can now put their deduction in their personal name. One of the good things is if you met certain conditions, you could put extra super in above the 27.5 limit. If you think that you'd like to put some more super above that limit and you still need to address that, give me a yell. We can check to see what your limit is and see if you qualify. You've basically got to have less than 500,000 in your account to be able to do that. So it might knock a few people out. We can do personal and spouse contributions. We can also bring forward non-concessional contributions, 330,000. This is a really good one that's going to happen for people aged between 67 and 75. So as you may be aware, to put money into super, you have to meet a work test. So that work test still applies if we're putting it in concessional deductions, which is basically, you know, where we're going to claim a tax deduction. But it's actually been dropped, and this is from the 1st of July, for those that are aged between 67 and 75 can put in non-concessional deductions, and they don't have to meet the work test. So the work test is where you're supposed to work 40 hours in a given time to prove that you're actually been working. So that's a good thing if people need to put more money into super. The downside, the contribution opportunity still exists, and that's been reduced from 65 down to 60. So there's opportunities there if you've owned your house for 10 years and you can contribute 300,000 into super, regardless of your balance. And the other one is co-contributions. So the question is going to be moving forward, and that's the $1 million question: what will the new government change, keep or scrap moving forward? I think they'll tighten some of these down the track because obviously they need money in the system to pay their taxes, and some of these are quite generous concessions for people. But there's more and more money going into super, and that'll continue as the years move forward, and hopefully less people reliant on the welfare system. Just a reminder of what you can do in 2021-22 in terms of contributions. We can put in 27,500. We can put in 102,500 in carry forward concessional. So that's up to 3 years. We can look back and see what you have put in. So, but you've got to meet that $500,000 balance. The non-concessional after the work test over the age of 67 post-June will be 110. The total balance under the 1.7. So the cap has moved from 1.6 to 1.7 now. So that means that any money above that is taxed at 15% when you're in retirement phase. But that cap is significant for a number of reasons, in the fact that it doesn't allow you to put any more contributions in once you're reaching between about 1.4 and 1.7. They have a sliding scale what you can bring in. The contributions that you can over 3 years is 330,000. So that's an important thing to note. And once you trigger that, you have to wait for 3 years to put in another 330,000. We have the downsizer contribution, which is 300 for over 65, which will go to 60 in July. And we also have the retirement, CGT retirement exemptions, which a few of our clients have undertaken. And that's up to 1.6 million for those 15-year exemption and small business retirement exemption. So that's a very handy one for those that have got businesses and going to eventually sell their business and want to roll that money into super. So they're our what we can do before the end of June, which is about 10, 15 days away. My suggestion is, if you haven't put money into super and you wish to, that you do that early next week, so you make sure it meets that deadline, because anything that isn't processed or entered into the system, whether it's your self-managed super fund or an industry fund, isn't counted as a tax deduction unless it's in the year that it's been banked. Here are the changes that are coming in on the 1st July 2022. Most of them we've now talked about. We've talked about under the age of 60, which is the employer contributions and the member contributions. We also have the removal of the age test between the age of 67 and 74, including the accepting of contributions up to 28 days following the month a member turns 75. So we're not trying to, we wouldn't want to be trying to put in contributions on that last 70 months of 75, but we've still got plenty of time between then and there, hopefully, to get some money into super. We've mentioned to most people the need for a corporate trustee, and I thought I'd just bring this into account for a couple of reasons. Just because we're trying to help our clients understand, as they get older, the ramifications of estate planning. And we know that, I know that some of my clients now have got corporate trustees, and as I go through to explain why it's important to have one. So you can have a choice of a corporate trustee or an individual trustees. In the early days, a lot of people, a lot of accountants, to save costs, would just set up a self-managed super fund with individual trustees, which is normally mum and dad. And as you'll see, there is a few issues as to why you wouldn't do that these days. On the 30th of June 2021, there was 65% of all self-managed super funds had a corporate trustee. However, moving forward, we found, the tax office found in 2021 year, 85% of self-managed super funds were established with a corporate trustee. It just makes a lot more sense, and you need it if you're going to purchase property in the name of self-managed super fund. Self-managed super funds with 2 members remain the dominant structure, so they account for 69% of most self-managed super funds. Self-managed super funds with a single member made up 24%, and then obviously those with 3 or more made up a small amount, and there was 4-member funds that made up 4%. From the 1st of July 2021, self-managed super funds can then register 6 members. Obviously, that's not available yet, but we'll talk about that in the slide coming up. One of the good reasons why you would have a corporate trustee, or why most people are encouraged to have a corporate trustee, is for 2 reasons. One, in the event of a death, the corporate trustee continues. So there's not a problem in the fact that if one of the members dies, we don't have to go do a whole lot of paperwork and change over the assets because it's in the name of the corporate trustee straight away. Secondly, it's so much easier to appoint a person's executor in that position if they need to be. We just need to appoint them as a director. And thirdly, if you've got more than 2 members, you only need 2 corporate trustees to make decisions. So it's just less hassle having, if you've got 4 members, to just have 2 corporate trustees. One thing Michelle has asked me to remind everybody, if you do have a corporate trustee, you need to do your director's ID. And okay, you've got another 6 months, but don't leave it till the end of November. So we know that in the event of a death or incapacity, the control of the self-managed super fund and its assets by corporate trustee is more certain. And it's also a good point to note, if you're a individual trustees and you die, then there could be a possibility that the bank might freeze some of those funds, bank accounts, because they don't understand whether it's owned by the super fund or yourself. And we have seen one case where it took a while to unfreeze that particular bank account. And the other thing that's also important is if you're bankrupt, the bankruptcy may chase down the assets because there's a bit of division as to whether it's an asset for the super fund or an asset for an individual. So it's even more important if you're in business to consider separating your assets from your self-managed super fund and your other assets, including your personal assets. So a corporate trustee can only ever have 2 directors. Or it can have 1 director as a sole person. So that saves someone trying to find another trustee if they're just one person in the fund. And the corporate trustee doesn't change. So the titles of the self-managed super fund assets remain unchanged upon death. And that's a good strategy moving forward. Now, there is talk now that you can have up to 6 people in a self-managed super fund. I guess there is some benefits of it, and there's also some pitfalls. And I think as you're doing your own estate planning, you need to consider your situation. I'll go through a little example in a minute. So first of all, the benefits of a self-managed super fund with family members in it is there's obviously cost savings, because the more people we have in it, the less costs of the shit they're shared around. We've also got more funds to invest in larger investments. So it means that mum, dad and the kids can combine their money and maybe buy a bigger property instead of a smaller property. If we already have a property in a self-managed super fund and we have to go into pension mode, there comes a point where if that's the predominant asset, then the fund needs to either sell the asset, transfer it as a lump sum to the benefit, the fund members, or get some money from somewhere else. So it could be an opportunity if you want to keep that asset for the long term in the fund to encourage the other family members to come in, roll their money in, and you guys get paid the pension out. So that's a way of keeping that asset for a long term, and that's a good estate planning method of keeping that asset for generations. There's also the great opportunities to share the responsibilities between young and old. And as we've talked about, there's some estate planning opportunities. However, there is pitfalls. It is more complex because we've got mum and dad who may be in pension mode, wanting to have less assets in riskier investments, and we've got the kids who are more prone to want to take some risk and invest in other things. So it makes it more complex. So we've got the conflicting interests. We've got how do we make the voting rights and the decisions to make these investments between mum and dad and the kids? Or is it dad that just makes those decisions, or mum and dad make the decisions because we only need 2 corporate trustees and the kids just come along for the ride? Also, if we've got a couple of kids in the fund with the mum and dad, and one of the kids or mum and dad for that matter go overseas, it may jeopardise the residency status of the fund, and that has issues long term. So the final thing, which is a legal thing, is to check the trust deed and the corporate trustee structure to make sure it's all set up right if you're going to go down that track. I personally don't recommend it's a good thing unless there's a really good reason, and that's mainly because of an asset that you want to keep long term. Otherwise, I think especially younger kids, I encourage them to go into their own fund or an industry fund and make their own way in life. Obviously, a relationship breakdown can happen occasionally, and superannuation forms part of the partner's assets will be included in the marriage settlement. This means that the ex-spouse may have access to the partner's super in the case of divorce. It also may mean selling this family business assets to free up part of the marriage settlement. It's interesting that in this situation, sometimes the judge will say that 60% of the husband's, in most cases, seems to be the husband's fund will go to the wife, and so we'll have to help do the split to make it more equitable. The other thing that's important is when there is a situation of divorce is what's happening with the binding death nominations and the pension agreement. So we'll have a chat to that in a minute. The other thing, apart from a relationship breakdown, is the control on death. And of course, have a think about your own situation and what wishes you'd like and what measures you put in place to make sure a self-managed super fund goes to the right people. So ordinarily, if we put in some reversionary or death nominations, it will go to the next dependent. But if there's none of that, it's the trustee that makes the decision. So there's been some classic cases in the last couple of years where the son, one of the kids, have been appointed as the executor, and there's been no instructions on the superannuation because it doesn't form part of your estate. You should note that. Then they've been catapulted in as the trustee of the fund, and they've made the decision on how they would best distribute the money, and doesn't not necessarily mean that it's going to go to the wishes of the dead person. So they may say that, oh, gee, I think I might give that money to myself or to one of my brothers that I don't like because I don't like my sister. And if that's not detailed in a binding death nomination or any other instrument, then there's nothing that can be done. So these cases seem to be frequently the courts at the moment, and there has been some famous cases where some people have done very well out of self-managed super fund inadvertently. So one thing that is a lot of discussion about, and I don't know if fully the results of this because you can read articles on binding death nominations, reversionary pensions, and all the rest of it. But I'll give you what I understand as the important points of why you need one or either. Let's talk about a person in a pension mode. They have the option of doing a reversionary pension or a binding death nomination. You can't have both. And the other thing that, as we've mentioned, is that superannuation benefits don't form part of your estate. Now, we're going through and checking what people have in terms of their pensions when we set them up, or if someone else has set them up, or they've been set up for a while and maybe circumstances have changed. So this year, we'll probably talk to you about your reversionary status of your pension and whether that's appropriate. So reversionary basically means that your pension, when you die, will continue. So you still have to make the minimum payment for that year, but it then forms part of the next person's responsibility. So, mum and dad dies or mum dies, the pension is transferred to dad or vice versa. And then that minimum pension for that pension must be made in that year, and that continues. So that's a reversionary pension. And we're going to make sure the pension is fully met in the year of death, otherwise it might lead to the status of the pension being non-tax free. The pension is transferred and it stays into super. Now, a binding death domination is the other way, and that will give important certainty to whoever's going to get the money. It must be per the trust deed, and it's renewable every 3 years. It's very useful if you don't have if you're not in pension. So in pension, you've got the choice, but if you're in accumulation, which means you're still putting money into super and you're still contributing, and you're still being taxed on it, then you can only use the binding death domination because you don't actually have a pension in operation. The binding death domination also means that a lump sum is paid out of super to the beneficiary, which is often a dependent, and then the dependent has a choice of deciding whether they can put it back into super or not. You can also make a binding death domination to your estate in this case. So we recommend that in consultation with your solicitor, that we make sure that it's set up right. And it's probably getting more complex as more people are getting older and accumulating more funds, and also having funds outside of their self-managed super fund. So they're the important things. And the final one, which I haven't mentioned there, which probably should be, is make sure you've documented your financial power of attorney, so that some of these things can be resolved quite easily without having to go to courts or solicitors or anything else, and make sure they're well documented. Now, when we talked about before of getting divorced, hopefully no one on this line is in that situation, but you've got to make sure that if you've got a pension in place or a binding death nomination, that you go and revoke those, so that if you die, your former spouse doesn't end up getting a windfall. So that's an important thing to note in that area. Of course, there's a few prohibited acquisitions by a self-managed super fund from members. So there's only certain things that you're allowed to put into a fund from you as a member. And they're listed securities, doesn't include crypto, business real property, life insurance, cash, obviously, widely held unit trusts, and an in-house asset would not tip the 5% limit. So we have noticed that some of these things have been done over the period of time, especially listed shares and business real property. We have also, not so much of late, but in the past couple of years, we have seen that some clients haven't actually got it right. And the reason they haven't got it right is they haven't done all the registrations correctly, so it's still in their own name, which is a contravention of the assets not being held in the super fund. So if there is a prohibited asset, and I don't think I've come across one yet, they're basically, the ownership must be reversed at no cost to the fund. And obviously the fund would become non-compliant for that particular year. In most cases, most of our super funds are in good condition and haven't gone down that track. We obviously have to do an annual audit, which means that every year we appoint an approved auditor. So we have always used an independent auditor, and that's been a good thing for our clients, because it meant, one, we've had independence, and two, they check to make sure that there's no errors. Or if there's a difference in opinion, we resolve which way it should be reported to the tax office. Our auditors we use are very good. They'll sit down and work through some issues with us, or if we're going to undertake a particular type of investment, we may call them first to see if it's approved before we suggest to our clients to undertake it. Obviously, with a non-compliance, it exposes the trustees to penalties, and we don't want that. So the penalties are getting a little bit larger. However, honest mistakes are often taken with the tax office, and they've taken a proactive approach to make sure that the trustee can get them fixed. So, but fraudulent errors or where people have taken money and haven't put it back, definitely are subject to penalties. Interestingly, crypto is becoming bigger and bigger in the self-managed super fund space. There's 227 million, which isn't a lot, at the 31st December, being incorporated into self-managed super funds. And in 2019, the ATO added crypto to its list of assets and released a draft ruling on how to record those. So I think there's a few things that we need to clarify with self-managed super fund and crypto. Is one, they probably have gone down along with the other equity of late, but make sure they're allowed under the fund's trust deed. So if you've got an older trust deed and you want to invest in crypto, we may need to upgrade the trust deed. Make sure they're in accordance with the fund's investment strategy. So again, every year we ask you to do an investment strategy, which is basically saying my fund will invest up to a percentage in a certain class of asset. So if you're going to start investing in crypto, we have to note that on our investment strategy as to why you're doing it and the percentage that you think you'll invest in there. There is make sure you obviously met the requirement constrictions around investment decisions with the SIS Act. Now, they must be able to provide and maintain proper evidence of a separate crypto wallet so that the crypto investments can be assigned fair market value to the super fund. So it can't be mixed up with your own crypto trading. Interestingly, and I don't think this has yet been resolved, and I don't know of anyone that's lost their wallet yet, but if you lose your password and that can't access your crypto wallet, is this regarded as a capital loss, and when would it be regarded as a capital loss? Unfortunately, I do know of some funds where people have gone and basically pretty much grabbed all their money and put it into crypto. And the tax office obviously don't like it. And the exposure for your investments is pretty high for your retirement. So if you're going to invest in crypto, do it in a sensible way and make sure that it's well documented. It cannot be transferred in specie into the fund, so it's not like shares. They won't allow that at this stage. The final note is that we are getting a lot of clients coming in with crypto, and previously the tax office didn't know how to track it, but now they have the ways and means of tracking crypto, and they noted on our list when we look at your return that crypto transactions are taking place. Crypto can be quite a lot of transactions, so we suggest that you use a crypto tax calculator to make the process a lot simpler, because otherwise it's going to take a lot of time for us to work through and the auditor to work through your transactions. So crypto, definitely do it if that's where you would like to invest your money, but make sure you do it in the simple way or the correct way. If you wish to discuss that, we're happy to talk. Asia does a lot of our crypto calculations. I've got a little bit of crypto, but I haven't looked at the last month or two because I know it's down a bit, but hopefully it'll come back up. Okay, property and your self-managed super fund. I'll quickly give people an update on that because we do get a lot of questions around property. Make sure it's what to consider as a part of an investment decision. Obviously, cash flow. People should make that long-term decision whether the fund can sustain it. So there's no point if you're not putting enough contributions in to sustain a rental loss. When we do a strategy now, we have to make sure that we allow for certain rental losses and explain to the client what could happen if there was no rent for a period of time, which basically means you either have to sell the asset or you have to contribute in to make sure you meet your obligations to the lender. So we've talked about the negative gearing within the fund. You can also have small amounts of negative gearing, or you can have a self-funded loan, which is basically not using a bank, using your own money and loaning it to the super fund. Either way, it just does take a little bit of work to set up. Take into account the future contributions which will support the asset. In the past, we have got away with, or well, clients have got away with just having one asset, which is the property within the super fund. Now the tax office are looking for a little bit more of diversification, and there's got to be a good reason why there's only one asset in the fund. The biggest thing is pensions and death. So what happens to your super fund and the asset if you die? Because obviously, if the asset's owned by two people and one person dies and that money has to be paid out to a dependent outside of super, how does that asset get split, or is it sold off, or what's the contingency behind that? And is it the right time to sell it? So that's something that you need to put into your strategy when you're considering buying into your a property into your self-managed super fund. Look at the appropriate investment types in terms of what type of property would best suit your risk and why you're investing in it. Don't go and buy something in Queensland just because down the track you might want to live in it, because that's not really the focus of how you should be investing. Obviously, interest is deductible, but just take a check. Most of our LRBA funds don't make a lot of money. They do make capital growth though, but mostly from an income point of view, the interest deductibility knocks out any revenue gain. And when do you trade the asset and get rid of it? So for some people, it's going to be take it out as a lump sum upon retirement. For others, they're just keeping it as an investment, and then they'll trade it once they go into. Most people will sell it when they're in pension mode and not pay any capital gains tax. And of course, for those that are using well, any type of particular property, make sure there's a lease agreement in place and the payments are made. That's really important for business real property. We've had a couple of clients during COVID and other times that haven't made those payments, and but they also haven't documented an agreement in place that there was a deferral arrangement, and of course that the tax office doesn't particularly like that. Why would you borrow to purchase your property in a self-managed super fund? Obviously, there's a good way of growing that asset because you're only, you're using borrowings to grow it. Obviously, some people will buy an apartment and then drag it out at the end to their house. We have done quite a few business factories and offices, and we've done a couple of rural land. So over the last probably 12 months, we've done probably 6 or 7 of these investments and loans. And once you know how to set them up and you've met all the conditions, they do flow relatively well. Probably about 3 years ago, a lot of the banks pulled out, and that did make it hard for a lot of people to be able to complete contracts or to get finance. But that finance market has now settled down, and it's there's probably about 5 or 6 people, good players, that will offer finance, and in most cases, not all, they do work out. So obviously you can pay off the debt and grow the investment, and then sell the tax-free investment once you're into retirement mode. So and you're getting better returns. And of course, there's a contribution cap strategy, and that might help get more money into super by getting a better return on the investment if you're reaching that contribution cap area. Okay, a couple of things to do with a self-managed super fund. You can borrow, but the loan has got to be purchased by a nominee trustee. So quite often, this trustee will be held separate to the super fund, and then eventually brought back into the super fund when the loan's paid off. And it's called, so the property is called a security asset. So the fund won't own the asset beforehand, but in theory it does, but it doesn't. And then an investment strategy is updated. the super fund has immediate beneficial interest in the fund, in the property, and has a right to acquire the title in the future. There's no stamp duty when it is brought back into the fund. It's just got to be explained to the State Revenue Office that there was a limited recourse arrangement. The thing that does catch a few people out is that you cannot use the borrowings to improve the property when it's under borrowing. So you've got to use money within the fund to improve that property if it's allowable under the borrowing arrangement. So they're important things to note if you're considering borrowing. And realistically, you probably need about 40% of the purchase price to be able to undertake any borrowings. They do say 20%, but it's realistically that they look at more equity in a property, and also look at the way people contribute on a regular basis to see if there's other cash flow coming into the fund. Suggest that you don't go off and hope that you can get finance for a self-managed super fund borrowing. Don't sign a contract unless you know for sure this can take place. We've had a couple that have had to lose their deposit because they either didn't do it right or they couldn't get the funding. The other thing you can do, and this was talked about last week, is that you can refinance your self-managed super fund. And that's important if you're in a situation where you've gone interest and now it's principal and interest and you want to slow that down a bit. There is some banks and some mortgage brokers that will do it. The only thing that you can't do is you're not allowed to take cash out, which means that the lending must be dollar for dollar. So it's basically just refinancing that existing debt into a better facility or a lower interest rate. So probably best to talk to a good broker that understands that, and there's a few of them around. You may find that your existing borrowing facility doesn't exist anymore with the bank, and you may, if you want to refinance, you might have to refinance to a new lender. So the other thing that I should note that we have a few people that get disappointed is that you can't use the equity in another property within the self-managed super fund to borrow for another property. So they've got to stand independently from each other, unfortunately. So what can you buy outright? Basically, commercial property, real property, business. And that's the one that you can do. We just get a valuation, and then it can be acquired from a member or a family trust or a business, and then put into the self-managed super fund. Residential property can't, the holiday house can't, and the overseas property definitely can't. And it's the only one that can be rented to a member is the commercial property business real. The rest, unfortunately, is not possible. You can acquire other property, like residential property, but you can't acquire it from a member. It's got to be from a third party. So here's a typical borrowing structure of how it works. We've got our nominated trustee, we've got our property, we've got our bank, we've got our repayments, and we've got the loan, and we've got income coming into the fund and expenses from the property, and we've got the repayment and the interest taking place. And we've got the borrowing secured by the property trust over the property, so, and the bank. There is some talk, indirectly, the members do guarantee the loan somehow. And there is talk with the ATO that they're not happy with some of these bank arrangements. So it'll be interesting to see what they talk about moving forward. We've had a few clients ask about investing overseas. Just be cautious with the trustee. Also check the title and who holds the property in the overseas country. We have seen some people that have had trouble getting their money back into the fund when they've sold it. We've got in USA, we've got a limited liability company holds the investment on behalf of the self-managed super fund. We also need an overseas bank account to bank the money, and you'll have to work out how to sell the property and collect the proceeds. There's also going to be some overseas taxable taxes, and and then that's obviously going to flow back into a credit in some cases back in the Australian tax return. Check also if there's a double tax agreement with Australia so that you can collect those credits. But really, probably suggestion is that you proceed with caution in heading into some investments overseas. A couple of things with property which are really important to note is you've got to charge arm's length rental. That's probably the biggest issue that the tax office are chasing down. Leave the property not available for rent, so you've got to show evidence of availability, and that includes, you know, real estate agents engaging. So we do have some people with holiday homes that get very little rent, and the auditor has had to request that to show that they have been available for rent. Staying in it yourself is obviously a no-no unless it's used for business real property. So you wouldn't be staying in it there, but you'd be using it for your, obviously, for your business. Renting it to family, that's a supposed no-no, and treating it like your holiday house. So obviously, any arrangements that you do, you've got to be able to document and show the tax office that you haven't undertaken any of those no things. They do catch people out occasionally, and it's like anything, they seem to have more evidence these days of being able to track what people do with properties and water usage and all the rest of it. So they certainly are starting to take a keener interest in things. So when you take on debt, I think we've covered most of this, is you've got to think about how long it's going to take to pay off. Do you have enough contributions to pay it off? Are you planning on selling the property to pay it off? And what type of loan structure will you use to give yourself a chance of paying it off? So really important, because we've had some clients that have really struggled to get lending, and they've signed a contract, and it's quite heartbreaking for everybody involved to try and get them over the line. So it's best to really think about this before you launch into a property, and talk to a broker to understand what's possible. It certainly is possible, but just make sure you do it properly. Just to wrap up, just so people understand what we do, is the market and the space I operate has changed quite a bit. So I used to be able to, someone would ring up and we'd be able to sit down and give some advice, and I'd probably document that in an email. Now I have to be reportable to the superannuation laws, obviously, ASIC and our dealer group. So I'm now licensed to provide self-managed super fund advice, but in doing so, I must take into account your personal circumstances, and then you'll receive a formal statement of advice from myself. So we can still do your financial statements without having to do statement advices and stuff like that. But if we're going to assist you with opening, closing, running a pension, doing a self-managed super fund loan, we need to go through the whole situation, putting in statement of advice. And my advice to you is then reviewed and supported by a dealer group. So that becomes a little bit more costly, unfortunately, but you're also made sure that we've thought through all the issues for you, and we've also had someone oversee that from head office up in Sydney. So I now prepare my statement of advice, it then gets vetted up in Sydney, and then if they approve it, I then will give that back to you, and we'll work through it and implement the plan. So unfortunately, costs have got greater, but I've decided I want to remain in this particular space. So, and I had to undertake quite a bit of study to keep my knowledge up. But it's a good area, it's a growing area, and most of my clients that we deal with, we have quite a few self-managed super funds now, and we have a really good team, and we're actually implementing a whole lot of new, hopefully this year, a whole lot of new software enhancements, which will help you guys as members. And that's, the software we're using is probably, there's about 6 in the space, and we're probably using not the top one because it's very expensive, but probably the second or